So last week for the main topic, we talked about non-blockchain based exchanges and why they are different and why predominantly most security tokens will trade there first for the time being. So T0, Archax, Merge, and many others that were well known in the space, they're all non-blockchain based exchanges. And as we discussed, Kyle, leveraging a fully blockchain based exchange is not exactly easy to do given today's environment where regulations around securities. Still, they are possible and inevitable for that matter. So let's take today's episode to discuss some of those benefits of a fully blockchain based exchange. And to clarify, we aren't talking about using blockchain for existing exchanges like for the NASDAQ or like the Australian Stock Exchange. We are talking about, we talked about that in episode 16, by the way, of the show, if you're interested in that.
Yeah, exactly. In fact, if you didn't know, you can just listen to any of our main topic segments exclusively on YouTube to get a little rundown of the main topic without having to dive in to the industry news from 6 or 12 months ago. But let's get right into it. Blockchain-based exchanges are truly the future, and these are, as you said, Herwig, originated blockchain exchanges. These are exchanges built for the blockchain. And so I think the best place to start is to focus on what an exchange does best, which is trading, clearing, and settlement.
Absolutely. From a financial services perspective, right, trading and settlement does seem to be the biggest thing, let's say, that's going to be disrupted by smart contracts and blockchain. The current process to officially record a transaction of security requires way too many different third parties, sometimes up to 40 different people. So in order for our listeners to, I think, really understand why this is better, first, maybe, Kyle, you should break down that trading life cycle.
Yeah, absolutely. So first, a trade is registered. An investor goes to a brokerage platform to buy or sell a security. So they register the security from a broker like TD Ameritrade, Robinhood, or even T0. So at that time, the broker sends the trade to the exchange for the transaction to occur. They must also inform the transfer agent of the transfer, who then reports the information to a centralized record-keeping party, which is then recorded and stored on the behalf of the brokers. In addition, there are other pieces I haven't mentioned that verify compliance, regulatory requirements, banking intermediaries, financial services companies, and other pieces that handle the custody of assets and information, as well as many other pieces that may fly under the radar. The reason that so many of these middlemen are required is because the information that each stores is proprietary. The financial sector is so competitive that none of these firms want to work with each other at risk of losing a competitive position in the market. Therefore, they'd rather work with an independent third party and then pass those costs on to the customer in the form of commission fees, liquidity requirements, bid-ask spreads, wait times on clearing, and more.
Yeah, and on top of that, strict regulation requirements force many parties even to have licenses that are either expensive, contradictory to their business practices. This creates a lot of unnecessary layers of complexity and even redundancy. Data privacy is, of course, incredibly important, but at the same time, you probably don't need 5 different firms verifying the same information, especially when each one is taking their own fee.
People generally hate fees, so this also explains why it can take such a long period of time for you to get access to your funds or to see a transaction clear. In this 3 to 5 day clearing period, your bank essentially has an interest-free loan from you to do whatever they want with it. This interest-free loan is known as the float and is a great source of capital for banks everywhere. It's also totally unfair to customers, but due to the convoluted nature of these processes, there's no real way to combat this solution until blockchain technology flipped the industry on its head.
Now, of course, with security tokens, right, we see compliance be directly programmed into the smart contracts, which, verify wallet access prior to the transaction. And that way, automation can very much be built in around regulation, which removes a lot of those manual requirements that traditional third parties usually handle, right? So additionally, the data isn't stored or collected anywhere, so investors don't have their data mined and sold like what we've seen even from firms like Robinhood. This seems like not a good business practice on how to be making money.
There are many more benefits for blockchain-based exchanges too. Like, Herwig, I know we talked about this before. What's the most interesting thing for security token exchanges leveraging blockchain that interests you?
Well, like 2 weeks ago, we discussed self-custody, and you can only really take full true advantage of that when the exchanges themselves are also powered by the blockchain. So more and more, we're seeing situations now where exchanges can support custody from a regulatory point of view because of the security of the blockchain, aka sending my tokens to a NASDAQ wallet instead of having Fidelity manage it, right? So not to mention all the redundancies removed, such as the transfer agents and cash custodians and all other types of custodians that need to get involved in the first place. So with all the securities being on the blockchain, these financial services don't need an acting custodian. They only need a technology provider. And of course, that means taking my securities and sending them to different exchanges, or not needing to do that at all because the exchange is, let's say, plugged into a partner that can support the trade completely and entirely programmatically between both of those parties because, of course, it's all on the blockchain. And of course, there are other amazing things that can happen now as a result of the blockchain. Payments is another one that's really fascinating to me.
So we talked about automatic dividends and such before, but what do you really mean from an exchange context?
Well, so we've already seen the context, of course, as you said, from an issuer perspective, right? They can automatically now distribute payments like royalties, dividends, coupons, you name it, to all their shareholders instantly. Even cooler, the wallets, aka the investors, can set to choose a certain type of payout, like USDC or Bitcoin or more of the same token. This is exactly where a blockchain-based exchange can come in and supercharge this. For example, using assets on its own exchange, the exchange can enable payment in other securities or automatically reinvest them into a portfolio of securities. This actually leads to what I see as entirely new fund strategies, investment instruments, and the more assets that are on the blockchain, the more that this can be taken advantage of. In fact, I think this is what leads to what we'll start calling programmatic liquidity.
Yeah, that's another interesting concept for blockchain and smart contract based exchanges. This idea of programmatic and decentralized liquidity. For small exchanges, both in traditional and in the blockchain world, providing liquidity for trading assets is the number one goal, but also one of the most difficult things to provide. In traditional sectors, we see market-making firms which specialize in providing the dynamics required to fill demand without ruining an asset's price. And then you see exchanges like Uniswap circumventing these difficulties by incentivizing peer-to-peer market making by leveraging a concept called liquidity pools.
Yeah, so liquidity is obviously it's a challenging concept. We will absolutely need to break that down in a future episode. But the idea here is that these smaller platforms can incentivize asset holders to stake their assets as well as dollars in a specific trading pair to provide the same liquidity as a larger market maker might, which essentially results in programmatic liquidity for certain assets. In both cases, the exchange has a supply of asset and cash to provide for interested buyers and sellers, which helps prevent slippage thanks to the instant trading in the background known as atomic swaps, which we also cover in episode 41.
The programmatic part ties into defining the price algorithm for a specific asset. These decentralized exchanges don't have an order book of sell and buy orders. Instead, they programmatically change the price of the asset based on how much supply is in the liquidity pool. And again, the supply here being both the supply of the asset as well as the supply of cash. In this way, they can have full price transparency as an investor can very easily calculate their price per asset if they're trying to buy or sell.
Okay, so if you're following along here, it should make sense then that as you try to increase the supply of the asset by selling it to the pool, you'll be drawing a lot of cash from the function, and when increasing the supply, you'll decrease the price per unit sold. In the same way, you'd increase the price per unit bought as the supply decreases, right? So this concept is known as slippage, which is what Kyle was referring to, and it is observed in both programmatic pricing as well as standard order book transactions. It's basically an economic law.
Supply and demand, right? As supply of an asset decreases, the price will increase, and as the supply increases, then the price would decrease. However, with a decentralized exchange, much of the cost of managing the liquidity is eliminated, because before, market makers would take percentages of the transaction, as well as upfront fees, bid-ask spread commissions, and other things. In the decentralized model, stakers are rewarded for providing liquidity on a volume basis, but there aren't any upfront costs or transaction fees associated. On top of that, programmatic exchanges leverage atomic swaps to power many trading pairs with just one liquidity pool, which allows the exchange to capitalize on scale as opposed to needing to find a market maker for each individual trading pair. This is also totally preferred by traders who can now swap assets interchangeably without needing to increase spreads for less liquid pairs.
Absolutely right, Kyle. And hopefully you wonderful listeners can now see how this empowers both the investors and the users of the platform in a way that's not really possible in the centralized context, right? The reality is, as much as what we talked about today isn't actually that hard to implement, most of the compliance requirements don't often change, which makes enforcement pretty easy as long as you clearly define the rules and requirements for each investor. From there, we can build technology to provide liquidity and trade matching, and as long as it follows the same rules and standards we set for the compliance checks, we should be able to run this autonomously. Then it's really just a matter of needing to audit the code, of course, and have a centralized oversight possibly to step in just in case, fringe events and things like that.
Exactly. It's cheaper, faster, and fairer for everyone involved. And for those reasons, I actually think that many centralized firms will push for these developments in some context, as they're going to realize that they can cut other competitors out of the process by embracing the decentralized nature. Even if we can cut the intermediaries from 5, 10, or 40 in some cases down to 1 or 2, I still think that's a huge win for everyone. Those select firms will adapt, and they're going to see a larger share of the pie, and investors will see a faster and cheaper access to their investment vehicles.
Removing middlemen, creating programmatic liquidity, new investment structure vehicles. We definitely covered a lot here, Kyle. I think that's fair because, of course, blockchain-based security token exchanges are freaking cool. But, we could probably go on, and that's all the time we have. So with that, fine, ladies and gentlemen, we conclude episode 57. Please leave any feedback in the comment section or reach out to us via LinkedIn or Twitter. We love engaging and having discussions about all this stuff, so never hesitate to reach out, and you can always join the conversation directly at stomarket.com/news2.
And just as a little Easter egg, if we got some people listening now, the first person that can ask me an interesting or cool question around something on this episode is going to get a shout out in next week's episode. So definitely reach out, let me know you liked it, let me know you listened, and let's have a good conversation. Find us on Twitter, LinkedIn, anywhere else. Thanks so much for tuning in. We'll talk to you next week.